Hello and welcome to today's episode of Nucleus Investment Insights. Today we're going to continue talking about the Australian property market and why it's worse than it looks. Interest rates have risen sharply with another 50 basis point increase by the RBA on Tuesday. There are many other pressures on households with inflation running hot, increased energy prices, and an overall increase in the cost of living. We're going to discuss the property market in depth and what this means for the average consumer and where this will likely lead us. On the agenda, we'll discuss the delayed impact of interest rate rises and how the average borrower is only just starting to feel the pinch. We'll also discuss the impact of over 40% of borrowers coming off fixed rate mortgages to much higher rates in the coming months. We'll also investigate the delayed second order and above and how this economic multiplier compounds the effects for months going forward and how this will flow through and affect the economy. My name's Sam Kerr. I'm a Senior Financial Advisor at Nucleus Wealth. Today, as always, I want to welcome the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen. Thanks for putting on this great show.
Thanks, Sam.
Excellent. Property. Always get lots of views for the property one, so it's going to be an interesting chat.
Yeah, absolutely. It hasn't been that long since we ran this, but in terms of time, but in terms of interest rate rises, it feels like it's a bit of another world.
Indeed. So just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform as our shows available on all the majors. And if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So now we've got that housekeeping out of the way, we'll get started. So Damien, I'll hand it over to you to get the ball rolling.
Yeah, sure. So I thought I'd start with the Interbank market again. So what this is doing, for anyone who hasn't seen it before, it's basically showing what what interest rate markets are pricing in. So this is what people have, billions of dollars of investments have been made on various bonds of different maturities. And if you extrapolate out what that implies, then it looks like interest rates still have another 1.5% almost to go, according to those markets, and that's all happening over the next sort of 6 to 12 months. And that's, but I guess what I wanted to highlight, and so that's sort of leading into some of the these issues that I wanted to highlight, is that most of the effects of the interest rates we've had so far really haven't been felt by the actual consumers, and so in a way, and I'm not quite sure which commentator described it this way, but it's a relatively apt description. It's the person at the bar who's just down 3 or 4 shots and then loudly claiming that they're not drunk is a bit like what we've seen with the interest rate rises so far. So we've had these sort of basically a record in terms of the change in your mortgage payments. So I've got another slide showing up. So this is. So that one was looking forward, saying there's still another, 1 and a bit rate rises to come, 1 and a bit percent rate rises to come. I've got this other chart which is sort of showing the change in mortgage payments over the last year, and we're in record territory. So it's almost 50%, just well above any other change in interest rates at any time. So yes, there's been bigger changes in terms of interest rates actually moving in the past. But the thing is, because we're moving from such low rates, what's happened this time is the actual amount of mortgage that somebody who has a mortgage has to pay. That's the part that's really increasing. And I've used here sort of somebody on a 25-year mortgage. People on shorter mortgages get affected less, but nevertheless, you can see even still on a shorter mortgage. If you're comparing apples with apples, it's still a record rise over a year in terms of the amount that we've actually changed people's mortgage payments by. So that's sort of coming and what's been so far. But then I wanted to talk really about when do these rate rises come through. And one of the guys from the Commonwealth Bank put up this interesting slide, Gareth Aird, who's been on our show a couple of times in the past. But so he's just showing that the May 25 basis point cash rate rise for a Commonwealth Bank mortgage holder actually only hit on the 3rd of August. So you had a 25 basis point increase in May. It took them about a month to sort of recast to minimum monthly payments on the last day of the month. Then they get a notice period, another 30-something days notice period, and then you've got this next sort of full repayment cycle. And then so from the 3rd of August was when that finally came through. So that means we've had another one. So just hit this month, but basically people have only seen 0.75% of the 2-point-something% increase rise we've already had. So my point is there's a delayed effect just in the cash flow side of it. So there's other effects as well, which we'll go through, but just until that actually genuinely hits somebody's account, it's for most banks it's at least 2 months, and in the case of CBA it's 3 months in this scenario, and I think that sort of 2 to 3 months is a pretty good indicator for most people about how long that's going to take to flow through. So that's delaying the impact. The second delayed impact is we've got a lot more fixed mortgages at the moment than what we usually have. So I've got a chart up from AMP just showing the amount of fixed mortgages versus the amount of variable mortgages. And so usually, fixed is sort of pretty close to 90%, well above 80%. Variable is well above 80%. Then we hit the pandemic, and we saw extraordinarily low 3-year mortgages, mostly funded by the RBA. So the RBA dropped and specifically targeted 3-year mortgages to get the lending down to those borrowers, and what that meant was we went from sort of 10%-ish in fixed up to about 40%, and then they will be rolling. So there's I guess what I'm getting to is those people aren't going to be affected until their mortgage resets, which means we're much more delayed than what would be in a usual cycle. So if this cycle had started in 2019, 3 months later, everyone would have felt the rate rises, whereas because we've got such a large proportion in that fixed amount, they're sort of sitting there not really affected yet, but will start to roll off over the next over the next couple of years.
And Damien, they're when they come off as well, they're going to have a huge jump in mortgage repayments, aren't they?
Absolutely. So, every variable ones are certainly in for a big change, but the fixed ones, most of these people would have fixed at below 2%, and so are going to be rolling off to probably close to 6 by the time they come off, and it could be could be even 7 if the market's right in terms of the pricing. So extraordinarily different, and some will make the argument that they've got lots of time to work it out and to change their habits and all that type of stuff, and to those people, I proffer that have you met real people? Like, people don't people don't change their behavior. Very few people change their behavior. Most people, especially for something so complicated, it's complicated. Things can happen. Rates might go up, might go down. It was only a year ago our own RBA governor was telling people no interest rate rises until 2024. And so people will wait until it actually happens, and then when it hits their account, when the payments are increased, that's when they'll actually change their behaviour, in my view, and that's tended to be the case in the past, and I can't see any reason why it won't be the case in the future. That obviously some people will be foresighted and look, work it all out beforehand, but the vast majority of people will simply wait until the bank says, bad luck, you got to stump up, double your payment, and that's when they'll actually make changes.
Yeah, that's right. And looking at that chart there, is that sort of showing that this is happening right now, and it's going to go back to sort of that 90% level where it's traditionally been, or is that sort of flowing through over the next?
So it's flowing through. So this is for mortgages taken out. So we still have a significant, we still have a significant amount of people who are on variable mortgages. And so this was the amount of loans taken out over that period. What proportion were fixed versus what proportion were variable. So there's a big chunk, the big hump there probably peaks in July 2021. Those people aren't going to come, their mortgage isn't going to come out until July 2024. But, you started the big amount back in July 2020. And so they've got, another, they've got another, whatever it is, 9 months to run. And they'll start, they'll start seeing those resets in terms of those. But I guess it's still, I guess my point still is that there's a lot to come through into those fixed mortgages who are going to be they're going to be hit the hardest, but there's still a significant proportion of people who are on variable mortgages in Australia and are already going to see, and so they're going to be delayed. And then we've got these fixed ones that's going to delay it a little bit more. Then you get, so that's the first sort of, that's our first two direct, what you sort of call a direct effect of delay. Then you get these indirect delays. And so, and what I mean by that is, so it takes 3 months for your mortgage rate to go up. It then takes a while for people to change their spending habits. So people are used to spending a certain level of money, and all of a sudden it's like, just a minute, I've had to spend an extra $1,000 or $2,000 on my mortgage. All this extra spare money that I used to have is no longer there, and it might mean that people just over that time frame they only cut their spending back a little bit and start eating into their savings, and then they realize no, I actually do need to make some genuine changes, and that's the point where so that could take sort of another 3 or 6 months as well before people really and run down the savings. And if that's so that's our next bit, is this indirect. It takes a little while to actually make something new, and also you'll have people who have pre-committed to, say, buying a car or things like that, and then but the next set of people will delay those purchases. Okay, I'm out an extra $1,000 a month. Maybe I'll wait a few more months before I buy that car that I wanted, or wait a few more months before going on the holiday that I was thinking about going on. Then you get this, what we call sort of delayed, the second order and above, the multiplier effect. So this is what drives most economies in terms of, and what the RBA sort of relies on in when it's to run its monetary policy, when it's raising and lowering interest rates, is that, okay, so let's say I've got a mortgage. It's just mortgage rate's just gone up. I've got to pay an extra $1,000 a month, but I'm not going to feel that for a few months because it's going to take the bank a little while for that to filter through to me. Then it's going to take me a few months to actually realize that actually I'm spending more than what I'm earning. There's a few months of, my credit card bill keeps running up, and I never seem to have any money in my bank account. And then it's like, oh, okay, I'm going to stop eating out as much, or I'm going to stop, I'm going to drop, gym memberships and start, cut back on some the non-essential expenditure. So that's your next sort of 3 to 6 months. And then you get the part that the people I've just stopped spending money on, so I've stopped eating out as much, and a whole bunch of other people have also stopped eating out. And now the restaurant owner feels that, oh, actually, I'm not making as much money as what I used to make. And I need to now, that person needs to then lay off staff or reduce hours. And then those people then have got, less staff, less hours. They spend less money, and that whole multiplier effect just flows right through the economy, in the fact that, everyone's spending is somebody else's income. And so this multiplier effect can take up to sort of 2 years to flow through. So most of the time, when most of the sort of various studies that central banks have done into how long an interest rate move takes, is that you usually get about half of the effect in the first year, and the rest of it comes in subsequent years. So we've just had a rapid fire, May, June, July, August, September set of rate rises. The first of which are only just hitting. I guess where I'm getting to on this is, whatever we're seeing now in terms of downturns is really just the tip of the iceberg. We really have not seen any major effect. And anyone who's sort of going, oh, well, actually, the economy seems to be weathering the rate rises pretty well so far, is a bit like that guy at the bar who's just sunk 4 or 5 shots in a row and feels like he's still not drunk yet. It's coming. It's just it's going to take a while for it to filter through, and the full effects won't be felt for up to 2 years from now.
Yeah, Damien, there's a great video by Ray Dalio called "How the Economy Works," just talking exactly about this multiplier effect. So I'll find the video. I'll post it in the chat there, so for people to have a view of, just to see how that really flows through the economy. When interest rates are rising.
So now let's have a look at, I guess, the damage that's been done already in terms of rate rises. So what I wanted to do is run through this property calculator that we've got and talk about what we're seeing in terms of the macro drivers so far and how much, what the effects we've actually seen and what will fix some of these. So I'll start with the sort of our feeling on what are the major factors, the major demand and supply factors at the moment. So I've got a chart with a whole bunch of sort of green ups and red downs. None of these are precise. It's more just I guess a rough feeling from a range of different factors that sort of went into it. And I just want to highlight, from 2012 to 2017, we had this massive house price boom in Australia, but we basically had every factor going all in the same direction, all helping sort of house prices higher. Then we came into a bust in 2018 where we had a Royal Commission. The credit availability dried up dramatically as banks all thought they were going to have to put a whole bunch of, well, they thought the Royal Commission would have some a bunch of things that they would have to do in terms of following up on in terms of limiting their lending. And so they all sort of preemptively did that, and that caused house prices to fall. Then they realized that actually none of those were actually happening, and so we had this whole COVID effect where we had this huge increase in the amount of credit availability. The price of credit plummeted, but at the same time, employment was down and population growth plummeted, and foreign buyers all disappeared. So this real sort of strange area but house prices managed to rise throughout that, and now we're in this sort of post-COVID part where the price of credit has rocketed up, and a lot of the other factors are sort of either you've got a mix in terms of other factors. Some of them positive, some are negative, some are a bit of both. The key ones for me is look, there's still credit around. APRA has been making some changes, and so it's not as good as what it was during the COVID periods, but it's certainly not restrictive in any way. There's a little bit from the banks in terms of starting to wind back on what they're prepared to lend, just given the rate rises, that's sort of reducing credit availability, but it's still not too bad relative to sort of a normal environment. The price of credit's obviously shot up dramatically, record speeds. The population growth is I've still got that as a question mark. We saw again last week, we had this big jobs summit and the call for more immigrants to come in, more skilled labor and things like that, opening up the borders and really trying to get that population growing again. Having said that, though, the speed and the take up is actually hasn't been very good so far, and it is potentially they'll have all these targets, which would be for quite a lot of population growth, but they might not actually get the people coming through. So I guess I still think that one's up in the air. But foreign buyers are still down, particularly Chinese buyers. But the rest of it's all relatively positive in terms of factors facing the housing market. So that gets on to what actually drives the housing market and how do we value houses. So there's a lot of different ways. My take in the long term, is that really we've got 4 different factors that are going to drive it. One is the relative amount of mortgage payments to rent. So basically, what that's saying is, if it costs $3,000 a month to rent somewhere, but it's going to cost you $6,000 to get a mortgage for it, people are going to be less likely to take a mortgage out and more likely to rent. If it costs $3,000 to rent somewhere and $2,000 to get a mortgage, then people are going to be more likely to take a mortgage out and go to home ownership rather than paying more than that in rent. So that's sort of your one factor, which is I guess going to bring this back in. The next one is your mortgage payments to wages. So basically, if people can afford higher mortgage payments, so you get a lot of wage growth, then people can afford higher mortgage payments, and then they'll be more likely to buy houses. The property prices to wages, I think this is less of a factor. So this is basically, can you afford a deposit? Now, there's lots of ways, I think, where if people can actually afford the mortgage payments on an ongoing basis, they can, beg and borrow and bank of mum and dad and other ways to get a deposit down, which will sort of get them started. But property price to wages clearly has some effect in terms of slowing people down. And then finally, your rental yields and whether on a net basis or a gross basis or compared to interest rates, and some sort of investment side that is this an attractive investment for people in terms of they can borrow money, buy the asset, and make a positive return. And that's not the case, and it hasn't been the case for a long time, that rental yields in Australia. So I think on that basis, we're sort of looking more at the top three and the top two in particular here, which is basically saying that what's really driving the housing market valuation is, can people afford to pay the mortgage? And on that basis, obviously with mortgage payments rocketing up, I had to redraw the axes on a number of these charts because they've just gone off the end in terms of the how expensive it is. The other factor I wanted to jump into just before I get to it as well is, and this is more about this short-term versus long-term idea, is that we get a lot of stuff in the press about and a lot of it does come from developers as well, is there's been an underbuild. The prices are so high because there's so much red tape and we're not allowed to build as much, and that's why that's why prices are so high in Australia. And there's with all good sort of propaganda, there's a kernel of truth at the heart of that, is that sometimes red tape does slow these things down, but there's the thing to note is there's a lot more houses out there than what are built every year. So every year, Australia builds about somewhere between 100,000 and 200,000 new dwellings. That's compared to 11 million existing houses. So the new additions is very, very low. And just to put that in perspective, 11% of those are unoccupied. We have about 2.6 people per occupied dwelling. And so if you wanted to basically absorb another 350,000 new dwellings, and what I mean by that is, you've got so you go out and build 350,000 new houses, and you're like, oh, that's going to drive house prices down because we've got so many new houses out there for people to build. Well, if the number of people changes in the second decimal place, so if the number of people change from 2.64 to 2.55, so there's still 2.6 people per occupied dwelling, that would get rid of that whole 350,000 new dwellings. If you want another 150,000, you just change your unoccupied rate from 10.5% to 11.4%. A few more people with holiday houses and all that type of stuff, and all of a sudden you've got another 150,000 new dwellings gone from the market. So my point is that in the short term, it's about economics. It's about, can people afford to buy that second house they always wanted, or can people afford to live in a place without as many roommates? Can kids move out of their parents' houses sooner? These are all economic questions. Can people afford, to have? Do they need to have 2 kids per room, in a bunk bed, or can they afford to buy a bigger house and get each kid in their own room? These are economic questions, and that's really what drives the short-term issues for me. And then the long-term issues are the ones we've spoken about in terms of the mortgage price versus wages and the mortgage price versus versus rents, because in the long term, I think when Sydney house prices at the moment, for example, roughly 230 something percent of what the rent payment is. So to put that in perspective, if you're paying $1,000 a week for a house in Sydney, then if you're renting a house for $1,000 a week in Sydney, then you could buy that same house for $2,350 as a mortgage at the moment. And that equation is, we've never seen it that high, and that's where I think the inevitable flow is to pull that down. So where are we? Yeah, so Sydney at the moment, 231% mortgage payments to rent. Melbourne's over 200 as well. Brisbane, Adelaide, Perth are all a fair bit lower, but actually pretty certainly in Brisbane and Adelaide, close to the records that you see within those markets. Sydney, when you get to units, it doesn't look as bad. When you look at mortgage payments versus full-time wages, again, Sydney's almost 100%. So basically, the mortgage payment is pretty close to a full-time ordinary wage, and that's pre-tax full-time ordinary wage. So you need on an ordinary salary to buy the median house in Sydney, you basically need two people to put most of their after-tax income into that, which again seems an unsustainable longer-term outlook. Something needs to give on that. Either interest rates need to come down, wages need to skyrocket, or house prices need to come down. And then, so you can see some of the other factors. It's worth noting these net rental yields versus interest rates. Only a year or two ago, they were actually looking pretty good, whereas now they're all you're quite deeply negative. So, and what that means is that you rent a house in Sydney. You buy a house in Sydney and then rent it out. And your net rental yield is, you're probably losing about 4% on that after you paid your interest. And then expecting obviously to make that back in capital returns, but that's
And Damien, that's going to have a flow-on effect as well, isn't it? The investors that are having cash flow negative properties, and some of them might have to sell them, and that'll flow through into the economy.
And they'll certainly want to put their rents up, which is what we have been seeing. And now this is a question, and now this will answer this economic question. So because some people sort of go, well, what would happen if rents just doubled? Like maybe rents go up 10% per annum for the next 5 or 6 years, and the compounding effect means that we double our rents. And you say, well, that is possible. It just seems very unlikely to me, given that's never the way it works out, and that what is more likely actually is to happen is that people will just start squeezing up. Kids will live in their homes with their parents for longer. There'll be more people have more flatmates. All that type of stuff will happen, and so landlords might be putting their rents up by 10% for the first couple of years, but then they'll just find they won't be able to find tenants for them because people just genuinely can't afford to live in properties that with fewer amount of people. You just need more people per house, and so you can get those rent rises for a little bit, but it's constrained by economics and constrained by wages. That's the other thing is our wage growth is terrible, and we'll get into that shortly. But it's on a real basis where we're going backwards at a rate of knots. And even on a nominal basis, so before inflation, it's really very, very quite low. And the accounts the national accounts came out yesterday, or earlier on this week, were basically showing that the unit labour costs are at all time or lower than what they were prior to the whole pandemic, and almost at the lows they hit during the pandemic. And what that's basically saying is, yes, the inflation we're seeing isn't coming from wages; it's coming from company profits being so high. Is really and your and energy costs and things like that. It's certainly not a wage-driven spiral in Australia. So if we look at the 3-month changes, so the next one of those ratios that I had just up there, So not a lot of changes in the property price to full-time wage. They're basically sort of keeping track with each other, or the gross rental yields. But you can see all the other ones are getting much worse. So, mortgage payment to rent in Sydney is up 30% higher than what it was 3 months ago. Melbourne's up 23%. And so that's keeping into account that rents have been rising as well at the same time as mortgage rates. If you look at the mortgage rates to full-time wages, again, just significantly higher. I think what makes the above table or some of those tables that mean a little bit more is if I look at them as a percentile. So what I've done on this final one is basically saying, okay, 1% is as cheap as it's ever been. So say for a mortgage payment to rent in Sydney, before today, if you'd hit 200%, so mortgages were twice as expensive as rents, then that rate is 100. It was as expensive as it's ever been. Whereas if it hit maybe 60%, that was about as low as it had ever been. And that'd be a 1% on this score. So everything's between 1 and 100. And you can see on those top the top three measures there for basically everywhere except for Perth. It's as expensive as it's ever been for affordability to have those. When you get to units, it's not as bad on wages. It's actually quite good in Brisbane and Perth on wages still. But the your mortgage payments versus rents are still getting up there, particularly Sydney, Melbourne. But I guess probably safe to say units look a lot less bubbly in terms of the prices, and a lot less would need to be done for units. Whereas houses is all-time highs on a whole bunch of different measures.
And Damien, what do you attribute that to, the differences between Perth and Brisbane compared to Sydney, Melbourne?
Yeah, look, Perth in particular did it very tough while the rest of Australia was booming. Sort of 2012 to 2017, they were busting at the time because the mining boom had sort of come off and the boil, and so Perth prices had been falling for a number of years, and so affordability was already quite good there before we started this rate hiking cycle and this latest sort of increase in prices. So there's still that hasn't completely reversed, I guess, in Perth, and possibly as well. There's a little bit more because of that. For people living in Perth, there might be a little bit less sort of faith in properties. Say if it always goes up, because they've just sort of been through a period where, yes, property was going up in the rest of Australia, but actually property was going down in large parts of Perth, and so you might have sort of less faith, I guess, in property as being an asset that just always goes up.
Sure.
On the macro themes, I'll just sort of run very quickly through them. Just some of the macro indicators. So mortgage rates, at 5.7 after the rate rise from earlier on this week. I haven't most banks haven't sort of moved to there yet, but yeah, we're fully expecting they will. Inflation rates. So that 5.7, that's still low relative to history, but it's but Australia's got way more debt now than they've ever had before, and so that's sort of a bigger issue. Inflation's running hot, 6.1. On the next one, we've got the wage growth. So in this one, I smoothed out. I should actually get the year-to-year one as well, just for indicative purposes. What I'm doing here is just showing the 3-year average wage growth, partly because just the actual annual series is a little bit volatile, and so this sort of smooths out some of the issues. Having said that, you do miss when you are getting big changes like right now, you can miss things. But it's just sort of showing there that the real wage growth, which is a blue line, negative 1%, has almost never been lower, and your nominal wage growth of 2% per annum, average over the last 3 years, is again pretty close to the bottom of where it's ever been. So certainly nothing to write home about on the wage front, and that's the real that's one of the things that sort of could save a lot of these ratios, saying yes, it's fine for mortgage payments to be double if wages have doubled over a 10-year period, but if they're growing at 2%, then it's very hard for people to take on those bigger mortgages. And then the rent growth has been good. We're actually this is ABS statistics, so they're probably pretty low relative to what we're seeing from a lot of the housing market statistics. So it's quite possible that nominal rent growth is understated, partly because there's also this stock versus flow part where we know rents out there have gone up a fair bit. The asking rents and the ones for places that are actually transacting. But on the flip side, most people don't renew their rents, and every week or every month or anything. So those rent growths will take some time to flow through to the rest of the economy, if and when they do come. Okay, so that's the macro outlook. The other thing then is to talk about is just a couple of specific markets. So I've got Sydney houses up there. You can see the mortgage payment to wages, 50% is probably the average. It's certainly been trending upwards over the last few decades, and that's quite possibly because there's more more women working, I think, is partly one of the reason for that. And then potentially sort of concentration of wages is another reason. But, it might be true that sort of is trending upwards and also as other costs sort of have been coming down in terms of things that people might want to buy in terms of houses and sorry, not houses, cars and washing machines and all these other things over a multi-decade period have been reducing in price, and so maybe that means people have more money to spend on their house. But having said all that, the average is still closer to 50%, and it's almost 100% at the moment. The mortgage payment to rent is, as I said before, 231%. So a place you can rent for $1,000, you can get a mortgage for $2,300. Doesn't seem to be sustainable to me. Units are not as bad, as you can see on the right hand side. So on those measures, I guess they got those measures were worse in 1987 around the 1990s, 1987 to 1990. Those ratios were worse for Sydney units, but not that much worse. And houses are worse now than what they were back in that period. Potentially as well. So the other one on the units, Sam, is given the pandemic, there is probably a bit of a there's less demand for units relative to houses. I think enough people being in lockdowns and wanting more space and to have to have some property. I guess yourself included, Sam.
Indeed.
Yeah.
I think lockdowns, living in an apartment with a young daughter made us reevaluate life, and we've now moved to sunny Queensland with a lot more space.
Yeah, that's right. So I think that's a lot of people making that same decision, and so arguably, yes, units aren't as expensive as they used to be, but that might persist for a while yet, and you might still see that houses, there's probably a reasonable argument again for them being more expensive than usual. It's just a question of how much more expensive than usual, and current levels seem to be, in terms of affordability, seem to be at levels that I don't think people will tolerate.
Yeah, and Damien, so prices in Sydney and Melbourne, they have started to fall.
Yes,
and we've discussed that it does take time for these interest rate rises to flow through for borrowers to actually see those changes in their payments. And is the market, has that already priced in these interest rate rises with prices already falling, or do you think over time, if interest rates do continue to go up, will house prices sort of accelerate the falls? The falls that we've already seen.
Yeah, I think absolutely. I think if we don't see a sharp reversal in what the RBA is doing, and a sharp finish to what they're doing in terms of raising rates and probably need a reversal, then absolutely. Yeah, I'm expecting that at the margin, your Sydney homeowner who's suddenly realizes they're paying $2,300 for a place that they can rent for $1,000. That might be fine for a few months, but at some stage they'll have to reevaluate and decide that, okay, no, I'll just have to sell this place and rent. Or it's probably more likely as well in the opposite direction is that people who might have been sitting going, okay, I'm paying $1,000 a week, it's going to cost me $1,500 a week to own the same place. Maybe I'll start looking around and find a place to buy. Now they're looking at it going, okay, it's no longer $1,500 a week. It's now $2,300. I can't afford that. I'll just have to keep renting for longer, and that's what will drive that down. I think you will see rent rises probably. They'll certainly try it, and I think they'll you will see some. I guess the question is at what point does the pain level hit enough that that you just get people when rents go up high enough that then people then just start moving more people in and you get that sort of squeezing up effect that can that I spoke about earlier, that can just take away years of supply.
Yeah, and I guess with in Sydney, if 97% of the median wage is going towards mortgage repayments, and there is a downturn in the economy and people start to lose jobs, and if you really need both people in a couple to be able to afford that mortgage, someone loses their job, that's going to force people to sell if they don't have significant savings and have that sort of multiplier effect again.
Yeah, that tends to be the factor that people will do what they can and cut back on everything else in order to keep their house as long as they can. But eventually, if they lose jobs, that's what ends up forcing people to sell, as you said. The question, always comes about though that's people cutting back on all these other things just so they can save their house. Has that extra flow-on effect for the rest of the economy. And so if that's happening at a broad level, then there's so much less eating out, there's so much less entertainment and other discretionary spend that does affect other areas and then makes things worse. So okay, that was Sydney. Brisbane's sort of interesting insofar as those ratios we spoke about, they're not as even in houses, they're actually not as high as they reached sort of in the mid 2000s for the mortgage payments versus median wages. So they're pretty close to as expensive as they've ever been, but they're not quite at that level. And having said that, though, they've come from like a year ago, they were actually cheap. So mortgage to wages, for example, in Brisbane was, I think, at like the 30th percentile or 25th percentile, and now it's at the 98th percentile. So it's only ever been more expensive than this 2% of the time. And very similar on mortgage payment to rent. So I guess the point I wanted to make on the Brisbane housing market is it's got expensive, but it's got expensive really quickly. Like it's now in the 98th and 99th percentile for most of these measures, but that's from being actually quite cheap not that long ago. And then looking at the units, as we spoke about before, they're not particularly expensive. They're sort of about at on a mortgage payment to median wage is at the 38th percentile, and on mortgage payment to rent is the 66th percentile. So so in terms of that basis, it's it's questionable. As we spoke about, people wanting to live in houses, but maybe at some stage, this just turns into an economic effect. Is that people will start moving more into units just to get away from the more expensive houses. Who knows? Then Adelaide's very similar to. I hadn't done Adelaide, I think, in some of these other ones, so I just thought I'd pop it up there because I know I've had a few questions about it. Very similar to Brisbane in terms of very close to record levels. Except mortgage payment to rents is actually a little bit below what we're seeing in some of the other capital cities, but it's come there from being actually quite cheap not that long ago, and rocketing up. And Adelaide apartments not looking particularly cheap actually relative to to say a Brisbane or a Perth. So with that, I thought it might be probably better for people to have a look at this property calculator, and I'll explain how you can sort of look for yourself and play around with some of the numbers. That's all right, Sam. We're live with it. Yep. Okay, so what I've got here, so this is at nucleuswealth.com/property-calculator. We load all the data in from all these different sources, so you can see and play with these ratios yourself and just see what the effects are. So, Sydney houses are expensive, but we'll use that as an example because it is more extreme. And Melbourne's not that dissimilar. So we're looking at a house in Sydney for $1 million with $200,000 deposit down. That sort of automatically calculates and says, well, based on rental yields and all that type of stuff, it's weekly $500 of rent and monthly $2,000. And so then we go, what are we expecting in terms of economics? And let's say we're looking at a moderate growth scenario. Now, then we get to how do we want to value this? So there's a whole bunch of different ways you can value it. The main two I'm going to focus on is this mortgage cost to wages and mortgage cost to rent. So by default, we put in that it's going to be the same as whatever the current level is. So that 96% isn't going to change. 96.5% of wages is not going to change over the next 10 years. So we're going to stay at this record high. And so we'll use that as our base case. And that's saying, well, if that happens, then if you don't have any debt in the property, then your property is going to grow, quite slowly, but eventually over time, your $1 million property is going to be worth a little bit more than what it's worth today. The issue is if you've got debt in that property, is you're going to lose quite a bit, and the reason why you're losing is sort of shown over here. There's $40,000 in entry costs. You'll get about $300,000 in rent over the next 10 years. In terms of property costs, there's about $100,000 in property costs, $600,000 in your interest. Your property goes up a bit. You pay a bit of exit costs, and net you've lost. You lost all your deposit plus another $50,000 to go with it on that basis. Now that's a relatively positive scenario. So I'll just sort of dig into the economic arguments behind that. Is basically saying inflation stays at 2.3, wage growth bounces, real wage growth, so including inflation, bounces back off its lows and back to sort of more reasonable levels. You manage to grow your real rent of the property at 1% per annum, and mortgage rates sort of stay at 6% and don't go any higher than that. If you then start to get into and your big assumption really is this mortgage payment stays at 97%. If you said, well, what would happen if it came back to sort of the 10-year average of 60% rather than 96? And at that point, you then go, well, what's that going to do to the property? Now you're losing money. You're going to lose $700,000 on this property as an investor. Some of that's from a change in property costs, as the property cost goes down by sort of 20%, but most of it's really from that your interest and property costs and just not getting back your money on rent. So if you bought the property with no debt, you get rid of most of those, and you're only slightly behind after the whole thing. But the net effect still is not a good return on those. Then if you said if mortgage rates go higher, that's obviously a positive or a negative. If they go higher, it's a negative for prices. If you sort of said, oh well, no, I think mortgage rates are headed back down to 3%, then that will sort of turn the whole equation around. Still losing money on this deal, but you're no longer losing anywhere near as much. And if you kept playing with that and said, oh, what happens if they go, what happens if mortgage rates go to 1%? Under these scenarios, now I'm making lots of money from property because I'm getting it, or whatever I'm losing on my, whatever I'm losing, I'm now making back because I don't have those interest costs, and I've got the property price going up in value. Now, is that a likely scenario? I don't think so myself, but I do think mortgage rates will come down, but they're most likely to go higher, and a fair bit higher, and 1%'s obviously lower than we've ever seen before in the past. So you'd need sort of to get us into that sort of European scenario where just low stagnant growth to get to those levels. But yeah, that's how you use a property calculator. You can choose sort of any of those different, you can switch between houses and units, and you'll notice we automatically change those sort of rent figures. If you want to go and overwrite that with your own figures, then that's fine as well. Just jump in and overwrite that, and you'll get your own figures on those. And switch markets, and again, those will change to whatever the local market is. So rental yields in Melbourne are higher than Sydney. So when I switch between Sydney and Melbourne, the rent jumps because I've kept that property cost the same of $1 million. So on $1 million property, you'd be getting a higher amount of rent in Melbourne than what you get in Sydney, and higher again in say Brisbane.
Okay, Damien, and so prices have started to fall, and there's other countries around the world that are further along in the interest rate hiking cycle.
Yep.
For New Zealand, for example, do you think we can draw any conclusions from what's happening there to what might likely happen here?
Yes, so I think New Zealand's a good example in that. They've effectively got the same banks as us, and so we are seeing they have a not as high, I think, proportion of variable mortgages, but it's a relatively similar economy. So yeah, we're seeing house prices fall, quite consistently in New Zealand, and so I think that's absolutely a reasonable thing to look at. When it comes to other countries, you need to be careful about which ones you're looking at, and you can draw some conclusions from them, but there are differences as well. So the US is a good example where they're one of the furthest along. And having said that, when we're talking about furthest along, we're talking about a couple of months really. They only started raising rates a few months before we did, but most people in the US take out 30-year mortgages, and 30-year fixed. And so most people aren't affected by changes in interest rates. It really only affects new home buyers. And what was the other thing? And the other thing in the US is they did have a pretty large housing crash not that long ago, and so they've just got some weird things going on that's not quite the same. So their building level is actually quite low. Arguably they haven't got enough. They've got a better argument to saying that they haven't got enough houses than say Australia does. There's one other factor on that whole building cycle. And sorry, prices started off at a lower level there, and different areas in the US will have they also have more. The supply expands a lot more quickly in some areas. So there's some areas like, say, San Francisco, which is actually very similar to, in terms of zoning and stuff like that, to Australia. Whereas if you compare it to somewhere like Texas, it's actually quite lax in terms of where you can build pretty much wherever you want, whenever you want, and they're a lot more, expand supply a lot more quickly in places like that.
Okay, great. So we've had a few comments coming through. There's one comment about long-term averages, saying that they're long-term averages for a reason. So a reversion to the mean is not unlikely. And then,
So look, and look, this is an interesting issue. Is that if your 50-year average is whatever level, but it's going to take you another 25 years to get back to that level. Obviously, that's 25 years is a long time to wait. I think there's certainly things that have I guess for me, I like to look at long periods because I like to see where it fits in the scheme of things over the longer term, but acknowledge that it doesn't necessarily mean things need to come back to those same levels. I think for the ones I've chosen, so mortgage rates to rent, I do think that is something which will oscillate around a mean. I do think that people will prefer to own somewhere, but over the longer term, if it's so much cheaper to rent than what it is to own, then people will drift to renting rather than owning. And so I do think there's something like that makes a difference. Something like the property price to wages. So just looking, I'm still showing the screen, aren't I? So if I
can go back there, yes.
Yes,
Yep, go for it.
If I looked at one of these property price to wages graphs, This one. Oh no, that's a sorry. I've chosen. Let me choose Sydney. Oh, I've chosen Sydney. Sydney houses. Let me do that one because that's a more extreme example. The property price to wages, used to be 2 or 3 times, and then it jumped to sort of 3 or 4 times, and then it jumped to sort of 6 or 7 times, and right now we're at 9 or 10 times for Sydney houses. Now, will this one revert to the mean, or is this an indication of falling interest rates over that whole time period and other factors? That's happening, increases in stamp duty, and there might be other things at play. So this property price, and given the property price to wages, you need to make that deposit once, and then once you've got that deposit, now it doesn't matter as much, because if you're in the property market and it's all going up, then you might have a higher deposit to upgrade to your next one and things like that. So that one I don't have as much faith in that being like what we call a mean reverting series, like it will come back to the average level. Whereas when I look at the mortgage cost to wages or the mortgage, when I look at the mortgage cost to rent, I do think that will be mean reverting. Mortgage cost to wages, probably mean reverting, but I do think there's, I wouldn't be surprised if there's a bit of an upward trend to that, as I spoke before about more, having more people working in, more women working and sort of better conditions for more participation by women in the workforce. Can help that potentially go higher, just because you may have more people living in the same house paying off that mortgage.
Yeah, great. And I just want to let the viewers know as well that within that property calculator, you can compare renting to owning, and also investing in property versus investing in stocks. So there's lots of different functionality in there. And a couple more comments have come through. One from Alex saying, I just feel the economy is on the edge of a cliff with the amount of debt and the property addiction. So I think that's pretty reflective of a lot of sentiment out there.
Yeah. And look, I mean, the thing is, there's obviously a bunch of us out there that sort of had these views for a long time. And that's always, for me, it's been a question about when. So I do think it's, in terms of house prices, that they've been way too high for a very long period of time. But it's been the falling interest rates that's helped that, and affordability and changes to regulations and all these other factors. I think there was a certain part, a few years ago where we were discussing that, what else could the government throw at it? Potentially there's things government can throw at it and try and arrest the decline. I don't think they will at this point, given the inflation. So I feel as if it is close to a cliff myself. I'm hesitant to say that with 100% confidence, just because there are things that can happen and that they could throw it off. But it seems very likely that of all the things that could fall, like when I look at something like this, it's like, well, are interest rates going to fall? Possibly, but unlikely right now. A rent's suddenly going to rise by 50 or 100% to justify all to help people pay for the mortgage. Unlikely, which leaves the only thing left is the property price to fall.
Yeah, wage growth is pretty low, so that's not going to save us.
Is shockingly low. Yeah, and that was that. There's been a lot of glossing over, the RBA's, a lot of talk about the RBA changing the, looking for 3 years of no interest rate rises and all these other things. One of the other things which I'm personally, I don't think gets enough airplay, is the fact that they've been so bad at forecasting wages that they eventually said, look, we've been bad at forecasting wages. We're going to wait until we actually see wage growth before we start raising interest rates. And here we are. We haven't seen wage growth. Yeah, and it's the part where you'd like, it would be it would be a completely different story if you're saying, yes, we've got 5% wage growth in Australia, we're raising interest rates so that things don't overheat and inflation, but when we've sort of got 2% wage growth, it feels feels a bit over. It's not working for the common person.
Yeah, excellent. Okay, so now we've got our viewer question of the week. So this is for viewers to have some discussion in the comment section over the coming days. The question for this week is, will rising interest rates pop house prices or just slowly deflate them? Feel free to post your thoughts and engage with us and some of the other viewers over the coming days. Damien, I'll pass it back to you for the investment implications now.
Yeah, actually, I'll just jump in quickly. There's one more question Wizlad had asked, which was about what are my thoughts on land property vacancy taxes and removing negative gearing. Look, all this stuff is great, but it's not going to happen. So it would be the Bill Shorten tried it and lost the election on it. So I think there are things that could be done to reform the property market. I just don't think they're going to happen in any short period of time.
Yeah, I mean, all those incentives are pretty well entrenched, and so many people benefit from it, and they don't want to give that up.
Yeah, absolutely. Okay, so investment implications. Look, I've probably already jumped into a little bit this. It is that idea that you've either got rental growth, interest rates, and house prices. One of those has got to give. Rental growth is trying, but it's interest rates have risen so much faster that it's going to have to be house prices that give. If you don't believe those interest rates that are priced in, and you think that those interest rates are going to stop rising, and once all this affects, once our man at the bar who's just sculled all those drinks, once he finally realizes that he is actually drunk, and interest rates start to fall, is now you're into buying bonds, buying international. That's where we've already seen the Aussie dollar fall a fair bit, but that's where you're going to get some safety. If you believe interest rates, then basically, and that they're going to stay high and go higher, and that's going to be, we're going to be in this prolonged period of high interest rates, then you want to sell anything to do with housing. You probably want to hedge your international holdings, and you, having said that, in both scenarios, it's much harder to come up with a scenario where you're looking at this and there's a good economic outcome in terms of with high interest rates. So, our take is that the high interest rates are actually going to start making some serious damage to the economy, and that's going to cause recessions and certainly a big slowdown in earnings, and that's going to then necessitate those interest rates to start falling again. But if you believe interest rates are going to stay high, then it's pretty hard to come up with a scenario where you don't start seeing the burden of adjustment start to fall on companies. And what I mean by that is that companies have, if you look at the share of GDP that companies make up of their profits, they've managed to grow that. So the consumer side is shrinking. We've got this big energy crisis going on, and at the same time, we've got companies making all these profits. In terms of writing the whole economic equation, that's where these interest rates, that's what interest rates are looking to do, is to slow that down, reduce demand, pull that back, and so it's either way. For me, it's hard to have a particularly positive outlook on profitability.
Great. So just to let the viewers know, Damien does write a full monthly property report every month. So you can see that at nucleuswealth.com/articles. There's numerous other articles in there as well. And just to mention again, the property calculator, go to nucleuswealth.com/property calculator. So that almost wraps us up. So yeah, Damien, thanks for sharing your views again.
Thanks, Sam.
Excellent. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comment section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact, and you can book a call with me or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. And also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all major social media. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.